Ladies and gentlemen, good day and welcome to the Mindspace Business Parks REIT's earnings conference call for financial results for the quarter and 9 months ended December 31st, 2021. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then zero on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kedar Kulkarni. Thank you, and over to you, sir.
Thank you, and good afternoon, everyone. Welcome to the third quarter financial year 2022 earnings call for Mindspace Business Parks REIT. At this point, we would like to highlight that the management may make certain statements on this call that may constitute forward-looking statements. Please be advised that our actual results may differ materially from these statements. Mindspace REIT does not guarantee these statements or results and is not obliged to update them at any time. We would like to reiterate that the acquisition of asset SPVs by Mindspace REIT was effective on July 30, 2020. Consequently, consolidation of financials of these asset SPVs with Mindspace REIT has been done effective August 1, 2020. Condensed consolidated first 9 months and full year 2021 numbers therefore reflect 5 months and 8 months financial performance of the asset SPVs. However, for the purpose of comparison, in the earnings presentation and for the purpose of this call, we have provided pro forma revenue from operations and net operating income for Q3 and 9-month FY21. I would now like to welcome Vinod Rohira, CEO, and Preeti Chheda, our CFO. Vinod will share the business update, growth opportunities, and his views on macro environment and the sector. Preeti will further share an update on the financial performance. We will then open the call to Q&A. I now hand over the call to Vinod.
Thank you, Kedar. Good afternoon to all participants. Hope you and your families have been safe and are doing well. Thank you for joining Mindspace REIT's earnings call. As envisaged during our last quarter earnings call, the sectoral tailwinds continued during quarter 3 financial year 22. We witnessed leasing of circa 1.8 million square feet in December quarter, taking the cumulative leasing to 3.8 million square feet in the first 9 months of fiscal 22. The preference of occupiers towards well-managed, top-notch Grade A assets, which offer the best in terms of health, safety, sustainability, and wellness, has grown stronger, and we have benefited immensely from this shift. During calendar year 2021, we are able to capture a significant market share of the gross leasing volumes recorded in our gateway cities. Well-being of our building occupants has been at the core of our health and safety initiatives, and we continue our journey towards providing our occupiers with best-in-class assets. Our efforts towards this cause continue to be recognized by the prestigious British Safety Council. We have won 7 Sword of Honour awards across 5 of our business parks, which recognize and reward these organizations that have reached the pinnacle of health, safety, and environmental management. The last quarter of 2021 saw a healthy pickup in leasing momentum. However, the third wave led us by the Omicron variant has caused a temporary disruption. Unlike previous waves, the restrictions in force this time were not akin to a full lockdown, and most states permitted almost all economic activities, including offices, to continue. While economic activity continued to remain stable and resilient, with technology companies continuing to grow and perform, the back-to-office plan saw temporary deferral. Compared to the impact of the second wave of infections, this wave has been thankfully largely mild and has not caused a strain on the healthcare infrastructure, having peaked much faster in line with the trend observed across several nations worldwide. Observing the pickup in the leasing momentum post the decline of the second wave, it is evident that offices continue to be in the mainstay in the post-pandemic era, as occupiers and employees alike have recognized the importance of having a collaborative work environment and the requirement for a deeper engagement. With the third wave already on the decline, we are confident that occupiers would resume their back-to-office plans in the coming months. On ground, we continue to see large technology companies evaluating spaces for new expansion and consolidation requirements. The leasing momentum that we have witnessed across our parks in this quarter is in tandem with the growth of technology companies and global captives. The IT industries and the GCCs in India have hired a record number of people over the past 1.5 years to cater to the changing technology landscape and increased focus on digitization. Few companies have already started formulating their footprint expansion plans to accommodate the increased headcount. Many new RFPs have started floating across micro markets, and we expect to see this activity assume greater momentum in the coming quarters. Coming to the updates on the specific micro markets, the established business districts of Hyderabad are witnessing recovery in demand, as pre-commitments and additional space take-up by GCCs continue to provide momentum to the absorption, and we are excited about the mark-to-market opportunity for our portfolio at Madhapur has on offer. In the Mumbai region, Thane-Belapur Road micro market is expected to witness three-dimensional demand driven by fintech, support activities of MNCs and data centers. The recent budget announcement conferring the infrastructure status to data centers will provide an impetus to the development of this sector. This move, coupled by data localization norms and upcoming launch of 5G, is expected to enhance the attractiveness of our assets in the Mumbai region for data centers. Also, the budget announcement to reform the SEZ regulations to aid ease of doing business and allowing inclusive participation of domestic businesses would augur well for the demand for our SEZ spaces in this region. Pune is witnessing strong traction for technology companies, and we expect this to lead to a buoyancy in demand. Our assets across the city have evinced strong interest from occupiers, which has helped us achieve robust leasing and occupancies. We have also successfully pre-leased our under construction asset, which is a part of a larger business park at Kharadi, Pune, to a leading e-commerce company. On the back of these encouraging trends and limited space availability at our parks, we are looking at advancing our future development pipeline to bring in new supply early. On the back of these macro tailwinds and strong leasing performance demonstrated by our team, we are gearing ourselves to cater to the demand upswing. We are exploring construction and redevelopment opportunities at our existing parks and continue to evaluate attractive inorganic opportunities from time to time. Our under construction pipeline now stands at 1.8 million square feet. In addition, we are seeking necessary approvals for redevelopment of 1.3 million square feet at Mindspace, Madhapur, Hyderabad. We are excited to have received the ROFO notice from the sponsor for Commerzone Madhapur, located in one of the prime business districts of Hyderabad. It is substantially complete and fully pre-let, circa 1.8 million square feet asset leased to a marquee tenant. We shall evaluate this and such other opportunities in the coming months. On the financial performance, our net operating income for the quarter grew by 3.4% sequentially to INR 3.7 billion. The 9 months NOI stood at INR 10.9 billion, recording a growth of 7.3% year-on-year. Our collections have continued to remain strong at over 99% throughout the pandemic. We continue to focus on having high-quality tenants in our portfolio. Our distributions for the quarter stood at 2.75 billion or INR 4.64 per unit. I would now like to take you through the specific operational updates for the third quarter. We achieved a gross leasing of circa 1.8 million square feet across 26 tenants for the quarter ended December 31, 2021. Of this, circa 0.8 million square feet was on account of releasing and 1 million square feet was under construction, vacant and new area leasing. Average rent realized of this 1.8 million square feet of leasing was INR 64 rupees per square foot per month. We achieved a re-leasing spread of 27.8% on the 0.8 million square feet area released. We pre-leased our entire under construction building of circa 0.7 million square feet at Commerzone Kharadi, Pune. In the first 9 months of this financial year, we have achieved leasing of over 3.8 million square feet across our portfolio. 82.1% of the leasing during the quarter was to existing tenants, while balance was to new tenants. Committed occupancy for the December quarter stood at 84.6%. The 0.7 million square feet of pre-leasing of under construction area at Pune done during the current quarter and the pre-leasing of under construction area done in earlier quarters are not factored while computing committed occupancy. These areas will add to committed occupancy post completion. The in-place rent in our portfolio has grown from 58 rupees per square foot in the previous quarter to 59 rupees per square foot at the end of the December quarter. Of the total leasable area of 31.3 million square feet, our portfolio has 24.2 million square feet of completed area, constituting to 91.8% of our portfolio value. 1.8 million square feet is currently under construction, and we have another 5.3 million square feet available in the portfolio for future development. The portfolio is leased to more than 170 marquee clients with a weighted average lease expiry of 6.9 years. One of the buildings at our project Mindspace Madhapur has won Best Commercial Development Award at the CREDAI Create Awards 2021. we continue to focus on building an ecosystem that prioritizes on environment, social well-being and governance, health and safety, sustainable development, and mainstreaming the principles of rightful business conduct continue to be our primary driver. We are certain that these measures will strengthen our position as a responsible entity committed to creating a measurable and positive impact. With this backdrop, I will now hand over to Preeti to walk you through our financial highlights of the quarter and full year.
Thank you, Vinod. Good afternoon, everyone. On the financial performance, we closed the third quarter of the financial year 2022 with a revenue from operations of INR 4.4 billion. Net operating income for Q3 FY22 stood at INR 3.7 billion, a 3.8% YOY increase over NOI for Q3 FY21 and a 3.4% increase on a sequential basis. The 9 months NOI stood at INR 10.9 billion, a growth of 7.3% YOY. We continue to maintain NOI margins at 80% plus. We announced a distribution of approximately INR 2.75 billion, which is INR 4.64 per unit for the quarter ended December 31st, 2021. The distribution comprises approximately 93%, which is INR 4.31 per unit of dividend, which is not subject to tax in the hands of unit holders, and approximately 6.9%, which is INR 0.32 per unit of interest, and other income of approximately 0.2%. This translates to an annualized yield of approximately 6.7% on the issue price. With this, the total distribution for 9 months FY22 is approximately INR 8.2 billion, which is INR 13.8 per unit. On the funding side, our leverage on the portfolio on a consolidated basis stood at 15.8%. Our net debt as on December 31st, 2021 was INR 40.5 billion. We have undrawn lines of INR 2.1 billion from financial institutions. Our low leverage levels and the strength of our balance sheet provide us the flexibility to pursue both organic and inorganic opportunities. Post the quarter end, we raised another 5 billion through issue of listed non-convertible debentures at an attractive coupon of 6.35% per annum. With this, our pro forma cost of debt has further reduced to 6.6%. We have achieved a substantial reduction of approximately 260 bps in our average cost of borrowing over March 2020. We continue to pursue opportunities to further reduce our borrowing cost. Our board has approved sale of approximately 40 acres of land at Mindspace, Pocharam, Hyderabad, as per the terms of the MOU, as was disclosed in our IPO offering documents. To conclude, we expect the improving market environment and the positive leasing trends to help the growth of NOI and distributions from the portfolio in the coming financial year. With this backdrop, I request the operator to now open the floor to Q&A. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. We have the first question from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good evening, everyone. Thank you for the opportunity. My first question is on this early releasing you have done in F23 and 24 of almost 0.5 million square feet. If you could just help us understand, is it like initiated by the tenants, and if so, then what is their thought process, and versus what you are expecting the lease rental whenever these would come up for expiry? Is the rent which you have achieved now higher or lower or on the market? If you just help us understand.
So primarily, it's very healthy business and a very happy moment when you have a client who's been with you for 10 plus years wanting to continue and renew, and who's in this environment seeing visibility of stability and growth and wants to renew early instead of renewing later. So we would grab that opportunity with both our hands. Having said that, we have got the mark-to-market rents that we were looking for from this tenant, and in fact, preponed that number, gave them the average values for the 1 year preponement, accordingly adjusted for that rent, and renewed early. So NOI went up while the rent that is the expectation of rent that we were expecting from that space on renewal. So it was a win-win for both.
Okay. Sir, could you share what is the re-leasing spread we would achieve across these deals?
It's about 28%.
28%. Okay. So and this excludes, is it included in the 9 months number? Just a clarification. This 37% odd releasing spread we have for 9 months.
Yeah. So whatever gets released, it's factored in this.
Okay. So and just following up, so are we expecting many more such early releasings to happen now, considering how the market is shaping up with things opening up?
So a lot of times this is part and parcel of business. You will always find a mix. Some tenants start talking of things early and some tenants talk closer to expiry. But those who want to renew are far more advanced in their discussions and they come quite early in the day to renew. So this is normal.
Okay, this is normal. Okay, sir, and just the second question is heading in FY23, the expiries which are there, the balance expiries. So how confident are we of retaining now considering the improved
We already have visibility of 60% of that renewal clarity with us.
Okay, so for FY20, out of the 1.4, almost
1.08.
Sorry?
From 1.4 we already pre-leased some. So what we're left with is 1.08. From there we already have 60% visibility going forward.
Okay, so sorry, just I got confused in numbers. So saying you were saying it is 2.5, right, which is expiring in 23, the area?
No. It's 1.4.
Okay, 1.4.
It was 1.4. 0.4 we already pre-renewed early. So from the 1.08 odd area, we have 60% visibility of that getting released already.
Okay, so just 4 lakh square feet of area is the
That's
balance
right.
which needs to be, okay.
That's right. And we have the whole year for it.
Yeah. Okay, fine, that's it from my side. I'll come back in the queue if I have more questions. Thank you.
Thank you. We have the next question from the line of Puneet from HSBC. Please go ahead.
Yes, thank you. Just a bit of clarification on FY23 expiry. So you said number is 1.4, but as per the presentation, it was only 0.23 of FY23 which is pre-leased. So does it still mean that you have to lease 1.1 or is it 0.0? Can you just clarify that a bit again?
It's 1. Go with 1.1 as a gross number, circa 1.1. From there we have visibility of 60% already.
Oh, from on 1.1, 60%.
On 1.1 we have 60% visibility of renewals already.
Okay, understood. That's helpful. The second is if you can talk a bit about Hyderabad as a market. The vacancies have gone up and a lot of construction is also due. How are you looking at your positioning in Hyderabad market? And if you can qualitatively comment more on supply coming from other players as well. So and obviously the demand side as well.
Okay. So cumulative, first I'll speak for myself, Puneet. We started the year with almost 1.6 million worth of vacancy and an under construction asset of 1.8 million. We will end the year with 800,000-900,000 of vacancy this year, and the rest of it we've already managed to pre-lease. So we see a far more healthier environment for our assets in Hyderabad, and we are actually eager to start construction faster on the 1.3 million piece because the under construction ROFO asset also has got pre-leased. So we want more supply, in fact, of our grade A assets. While yes, there is an overhang of visible vacancies in the macro market, each asset is going to be looked at very differently, as we have been mentioning to you in the past as well, that they're far more choosier about what they want to pick on and what suits them best for their business. And if that asset stacks up, you're getting it leased first, and that's what we're seeing.
Understood. So even the new construction is not all grade A quality.
There are a lot of aspects that may have got missed out in the volume development that generally took place prior to the pandemic. Some of those volume developments may or may not stack up for the well-being, health and safety protocols.
Understood. That's helpful. That's all from my side. Thank you so much.
Thank you. We have the next question from the line of Atul Tiwari from Citigroup. Please go ahead.
Yes, sir. Thanks a lot. Sir, on this ROFO asset, just a couple of questions. Would it be possible to share how much annual rental it has been leased at currently?
Unfortunately, we can't give you those numbers, Atul, but happy to address any other question around the
Okay, sir. And sir, okay, so if we decide, what is the kind of timeline we are looking at, to kind of complete or evaluate this deal? Any idea on that?
Atul, hi, Preeti here. We just got the board approval to start our evaluation, and in the next coming months we will. So I would say between now and the next quarter is when we'll be evaluating and then taking it back to the board.
Okay, great. Thanks. That's all.
Thank you. We have the next question from the line of Rahul Marathe from ICICI Prudential Pension Funds. Please go ahead.
Yeah, thank you, sir, for allowing the opportunity, and congrats on the good set of numbers. So, sir, my question is regarding the two related party transactions that we are seeing in this quarter. One is the sale of that land of approx 40 acres, and other is with respect to the chalet hotel deal. So if you could just throw some more clarity on both these transactions.
Yeah, hi, Preeti here. So firstly, regarding the 40 acres at Pocharam, so this transaction was already envisaged at the time of our offering. This was already disclosed in our IPO offer document. But since we were awaiting certain SEC notifications, we could not conclude. We've now received the notifications, and therefore we will be concluding this. So this is 40 acres is a part of our Pocharam Mindspace development in Hyderabad, and this 40 acres was already contemplated to be carved out. So we are just concluding the transaction, which was already disclosed. So that's on Pocharam. The second one was we also have disclosed another MOU, which we had signed with Chalet Hotels for a small 2-odd acre piece of land at our Mindspace Airoli asset. This is again a part of our offering disclosure. Again, we are awaiting certain approvals there. So in the meantime, we have extended the MOU. Yeah.
So at what valuation is that 40-acre deal happening?
So that's at 80 crore, which has been disclosed in the offer document.
So for unit holders, will the proceeds be passed on in the form of distribution, or how it will happen?
So, if there is no alternative immediate investment plan, then we would, make this a part of the distribution.
Okay. Thanks. That's it from my side.
We'll have to just evaluate that, but that's broadly how it will work.
Okay.
Thank you. We have the next question from the line of Kunal Dayal from Bank of America. Please go ahead.
Sure. Thank you. Two questions from my side. Firstly, just wanted to better understand the benefit you are expecting on your SEZ assets post the development of the budget. And then the second question was, around the ROFO opportunity. I guess you broadly know that some of the considerations include maybe next activity ought to be accretive. But given that, interest rates probably are at a low point right now and would look to increase sometime in the near future, would there be a special consideration you would bake in for such a scenario, maybe have more than normal expected accretion from an acquisition? Thanks.
So first, hi Kunal. So to address your question on the SEZ, it's broadly in lines with what we were saying, in the legislation that is likely to come through will allow us far greater flexibility to have rupee billing and coexist equivalent of STPI occupiers on the denotified portion, which will hopefully be unit-wise, and that will just open up the supply to be offered to non-SEZ demand, which we have seen very well turn out for us from the building we denotified in our Airoli Park last year, and we've seen huge amounts of traction of demand there and done significantly well on our leasing in that building as well. So we are hopeful of that coming through. On to the second part of your question, on the ROFO asset, primarily this is a grade A asset which was customized and built to suit for a very high-end technology company. who's just taken this entire building up for their primary office in India. And in the right micro market of Madhapur, it's a very attractive asset from its intrinsic value and from the way it is spanned out from a value perspective. We would be excited to look at that ROFO opportunity. Interest rates, yes, short, medium, long term, we all know, but we're still very, very excited about looking at this asset and its value being accretive for the REIT.
Understood. Thanks, Sir.
Thank you. Ladies and gentlemen, if you have a question, you may enter star and 1. We have the next question from the line of Shashank Savla from Somerset Capital Management. Please go ahead.
Hi there. Thanks for the opportunity. My first question is on the mark-to-market potential, where if I see for the last 6 quarters, it has been gradually declining, like from 17% to now 7%. So can you throw some color on that and as to what's driving that? And because I thought some of the other projects which might be expiring would stabilize the mark-to-market potential going forward.
Yeah, so this mark-to-market was really in line with the estimates that we had given forward in terms of the broad rents we were hoping to achieve. As the markets are firming up and getting stronger, we see a better opportunity going upwards from there. But so far, we've just maintained this.
Right. And the second question was on the distribution. So if I look at the NDCF levels, there is an inflow from debt of 2,195 million versus the capex is around 1,500 million. So I was just trying to wonder if part of the dividends are being funded by increase in debt.
Yeah. Hi, Shashank, Preeti here. To answer your question, see, and this is something which we've been talking about in the previous calls as well. There's always some amount of phasing which is happening in terms of the cash flows. So this time also some of the reasons why you see this gap between the capex and the overall debt drawn. So we have certain elements. So one, of course, is, the fit out, which I've always said, part of it gets, while we consider it as capex, it gets, for an accounting purpose, gets clubbed under operating cash flow. So some amount sits there. And for us, all our capex, including fit out capex, generally is funded out of debt. So you will have to look at both together. So that's one. Also, because we've done extremely good leasing in this quarter, we've had incremental brokerage payouts as well. Another element has also been, because of certain power disruptions, which all of us have heard of in the last quarter, the power costs have gone up. But, given our arrangement, the true-up of this, which true-up as in you can recover that from the tenant, that happens subsequently. So to that extent, you have an interim, I would say, a mismatch. So all of these factors have contributed to this gap. But again, as I said, because these are all phasing issues, we generally try to normalize this. That's the reason you are having this gap in this quarter. And of course, there are again certain prepaid expenses for both the quarters which get paid in, the starting of the second half. So all these factors have contributed to this gap.
Right. Okay. Thank you.
All right. Thank you.
Thank you. We have the next question from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Yeah, hi. Thank you so much, and good evening, everyone. Preeti, just picking up from the previous question, which is in your EBITDA to NDCF flow. It's not the only quarter where we have about 50-70 crores excess borrowing versus the capex. And you do cite some of these cost heads every quarter. So, but this has been sort of there for all the last 5-6 quarters that I can see. So how should we model this? Do you think this is something that's a recurring thing, will continue, or at some point in time this should taper down?
So, Sameer, just to answer, let me just start with the second half of last financial year when we did our first distribution. At that point in time, we did the distribution only in the second half. We did not do in the first half. And in fact, I had mentioned even in the earlier calls that a big chunk of our tax refunds, which were envisaged in the second half, we got in the first half, which we used to repay down the debt, and therefore we had to borrow. Otherwise, in that financial year, there was absolutely no gap in our operating cash flows to meet our dividends. Now coming to this financial year, as you rightly said, there has been a gap on all the 3 quarters. So some of the gap we had envisaged even at the time of our offering, which I had mentioned even last time, and the other gap have been contributed. One, we had almost 35-40 crore of tax refunds, which were again supposed to come in in the first quarter of this financial, which we got earlier in the last quarter, which obviously once we get the cash, we use that money to pay down the debt. And therefore, in that quarter, when we are actually doing our distribution, we have to draw the debt back. That's why you see some, debt being drawn to fund the distributions. But that's because every time we get some earlier cash flows, we use that money and pay down the debt. And sometimes if we are falling short in this month and we know the cash flows coming in the next, then we make sure that we normalize. So that's the reason we are seeing these mismatches. But again, Samir, to broadly answer your question, some was envisaged even at the time of IPO, and some of these are phasing issues which should normalize as we end the year.
Okay, that's fine, Preeti. It would be, good if you can have some disclosure around this. If it's just a timing issue, that's fine. Some cash come early, some late, etc. So that clarity, if you can provide in the presentation, it would be great. So that's the request.
Sure.
We'll do that.
Thanks, Samir.
Yeah. And the second question is on the ROFO asset. How do you plan to fund that?
So Samir, while the entire structure is something which we will start working on and evaluating, but one form of this acquisition could also be swap of units of the REIT with the shares of the SPV coming in. So that also could be one probability, in which case we may not need any capital for the acquisition. So that's something still under evaluation. We'll come back to you guys once we have completed it.
Sorry, Preeti. So did you say it would be by issue of units? Is that what you said?
Yeah, something. One option which is possible could also be swap of units. So in which case we will not actually have any capital requirement.
Oh, I see. Oh,
yeah.
Got it.
But that's again still under consideration. Once we evaluate the asset and get to a final stage, we'll have a better clarity.
Okay. Okay, that's fine. And the other question I have is with regards to 85% say occupancy. So we got about 4.5 million square foot, which is sort of vacant. Hyderabad and 2 assets in
3.56 million.
Sorry, my bad. 3.56 million. So between Hyderabad and 2 Airoli. So how do you see this take up going forward? And B, is it also related to physical occupancy, employee footfall coming back? And what's the visibility on that? Thank you.
So, like the way we had envisaged and we saw that in the previous quarters, it's panning out in the similar direction. Samir, we are seeing the large RFPs first come through, and those large RFPs will set the trend for demand for build to suits or customization or larger footprint for 12, 18-month to 24-month business plan for most of these occupiers. And along with that, you will start seeing the pickup of the 50,000 and the 100,000 square feet occupiers. And the immediate need for growth, etc., when physical occupancies start rising, which I believe will happen between March and May. And that's the time you will start seeing the smaller office take up as well pick up. So the way we see it is, Hyderabad, I'm quite excited because we have only that supply, and when the demand starts coming in, we will be able to encash the opportunity of mark to market. From a Airoli perspective, we are seeing within the non-SEZ space demand picking up steadily and nicely, and great occupiers looking at that space. We've done significantly well, much more than we had envisaged at the beginning of the year. And we are excited about the SEZs allowing denotification to happen to accommodate those kind of occupiers. So while that will go slower till the denotification comes through, we have some tailwind here because we have some under construction supply available in the non-SEZ, which we'll quickly keep leasing, and are hopeful by then we will get the catch up on the supply of the SEZ becoming denotified, so that the continuity for our business remains in that space. So you'll see a slight lag there. We see above the 90s in our occupancy, as we had mentioned even last time, by the end of this next financial year.
Okay, no, that's great. And would you say that your, in next 2 years or whatever time frame, your steady state occupancy should be what, 97, 98%?
We would all hope for all of those numbers. Yes, absolutely.
Okay, great. One final, if I may, from with your permission. So on Airoli East, I think about 2.1 million square foot, ability to do brownfield. Any thoughts on that?
So we are looking at a lot of data center opportunities. While anyways the value that we've embedded in this is nothing, so whatever comes is bonus in that sense. But there is a combination of customer as things stabilize, we'll come back with those things.
All right. Okay. Thanks.
Thank you. We have the next question from the line of Mohit Agrawal from IIFL. Please go ahead.
Yeah, thanks for the opportunity. My first question is regarding how do you see the FY23 distribution now? With FY22, it looks like it's going to be around 1,000 crores, given that we've had a similar run rate for the first 3 quarters. Could you give a sense, and we've seen about a 10% increase in our blended rentals over the last 4-5 quarters. The occupancy level seems to have broadly stabilized. What kind of a growth do you envisage in the next year?
So, hi, Preeti here. So I wouldn't be able to put a number to this, but directionally, we should definitely see a growth in the distribution vis-a-vis FY22. Given that, of course, we've done a good amount of leasing in this year, and the rentals of those leasing should start flowing in the coming quarters. And of course, the routine growth in terms of escalations, mark to market, which will come. So directionally, yes, we should be seeing a growth in the distribution, but I won't be able to put a number to that.
Yeah, but at least like we've seen 10% increase in blended rentals, at least that kind of distribution growth should we expect more than that?
Most honestly, we won't be able to comment on the percentage growth. I can only set direction.
Okay, fine. Okay. My next question is on, the Hyderabad market again. In the presentation, we have mentioned that there's about 5 to 6 million square feet of RFPs, and there's also mentioned that large deals are now coming back. Is it possible to give a sense of how this compares to the pre-COVID times? Broadly, where are we in terms of the interest and the RFPs and inquiries, if that is possible?
So in the peak, which was just pre-COVID, Hyderabad ended up with 14 million square feet of gross leasing.
Okay, with gross leasing. Okay.
So
this is roughly about less than about 50% of where we were at the peak.
Currently, that's right.
Okay. Thanks a lot. That's all from my side.
Thank you. We have the next question from the line of Satinder Singh Bedi from Eon Investments. Please go ahead.
Yeah, thanks for the opportunity. Congratulations, Vinod and Preeti, for a stable set of numbers.
Mr. Bedi, this is the operator. I'm sorry to interrupt. The audio from your line is muffled. Could you use the handset?
Yeah, okay, I will do that. Is it better now?
Sure, thank you. Please go ahead.
Yeah, okay. So first question is to Vinod. Vinod, I couldn't get a full hang of the SEZ and non-SEZ in terms of the budget, because Airoli West, like you mentioned in the last call, that once this regulatory change or legislative change happens, Airoli West should see better time. So I just wanted to understand what is the update on that. Okay.
So we are waiting for the fine print to come through. The pointers that have come out from the various government agencies seem to suggest that they are looking at these as employment generation centers, and they want to promote and grow these businesses in these micro markets and these ecosystems, and they want to be facilitators for this, allowing for flexibility of businesses to grow and coexist, similar to the regime that was earlier there in terms of unit-wise SEZs, STPI units or EOU units which could coexist in the same building as units. and allow for rupee billing and allow for domestic billing, etc. So all of that as a combination is being worked out. We are very hopeful that it will come out in that shape and form.
Okay, so this flows from the budget announcement? Your understanding of the budget announcement?
Speech, but they're working on this in any case in parallel, and they've said on or before September of 22 they would have announced the policy.
Okay, fine, thank you. Next question is to Preeti. Preeti, we have a floating debt of about 3,300 odd crores, and the general market consensus is that the interest rates are at the lowest possible, and they are probably headed for a move up now. Any thoughts on converting this into fixed or something like this, locking this in, given that probably consensus view is that we are close to the bottom?
Yeah, hi. So as we talk, we've already converted almost 50% of our debt into fixed cost debt. And as you rightly said, we are at the bottom of the interest rate cycle, and we do expect that in the coming there could be rise in the interest rate. So we are working towards converting a little more of our floating cost debt into fixed cost. So that's something which is already in the works.
Okay, yeah, thanks. And Vinod, regarding your Square BKC, when does the rent start? Because it's already moved out. Yeah.
First quarter next year.
First quarter next year. Okay, so will it be fair to assume that maybe 50, 60, 70% of this rent will incrementally flow down to the distribution? Is that a fair assumption to make, that in the next financial year, the rent at $270 for 0.1 million into 12 months, about 60% of that should flow down to the distribution itself? Is that a fair assumption to make?
Approximately in that range. I can't give you an exact number on that distribution, but yes.
Okay, fine. Okay, thank you very much. This answers the queries I had. And just a small comment, taking up from what Sameer also pointed out earlier. Is the great if the amplification of this NDCF flow, Preeti, could be provided in terms of the debt drawdown? I think it will offer a lot of clarification and greater confidence in the whole thing. Okay, thank you very much.
Sure, Satinder. Thank you.
Yeah.
Thank you. We have the next question from the line of Adidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, thanks for taking my follow-up question. My question is on the slide 45 on the portfolio summary. Could you just help us understand in Airoli West the gap between occupancy and committed occupancy? So when does this 7% gap get operational? That is first question.
Sorry, can you repeat that question?
I'm seeing in your Gigaplex asset, the current occupancy is around 60-odd%, whereas the committed occupancy is 67. So when does this gap get breached? Means when do the tenants start? When does the rent start for the balance 7% of the area which is there, the committed occupancy?
Yeah. So generally, whenever we sign the letting, it generally takes about 4 to 6 months for every tenant to do the fit out. So that's exactly the timeline that we expect for the rent to start.
This is something which will start flowing from second quarter of FY23. Is that a correct way of looking at it?
Between first and second quarter.
Yeah.
Between, okay, sometime in the first half, of next year. Okay. And similarly for this Kharadi, the pre-leasing we have done, so when will the asset become operational?
The approximate rents in this asset may start from first quarter calendar year 23.
Okay, or Q for FY23, if that the other way to look at it.
That's right.
Okay. So the occupation start 6 months prior to that. Okay.
Yeah, occupation is scheduled end of third quarter this calendar year.
Okay. And sir, this pick up in leasing. So Especially, so the rent-free periods, do you again see them now coming down from where it was now because of pandemic? We are giving higher rent-free periods across the board. So
it's really larger clients require a larger amount of time, so that's what's getting translated. When the smaller areas start getting picked up, you will anyways, that means see that the market is really picked up. Whatever is fair and justified in the current scenario is what will become as rent-free. They continue to be part and parcel of business. There's no dramatic difference in what used to be done and what is getting done.
Okay. Fine, sir. That's pretty helpful. Yeah. Thank you and all the best.
Thank you. The next question is from the line of Sri Karthik from Investec. Please go ahead.
Thank you. I know you clarified regarding the fact that there could be timing difference with respect to tax receipts on NDCF. But if I even take a 5-quarter view, almost 20-25% of our distributions are being funded by debt. So if you could further clarify as to why such a large portion of it is being funded through debt drawdowns, that'd be useful. That is one. The second question is, if I might have missed it, but the pricing of the land transaction, is it in line with the recent Telangana government's land sale price of about roughly 40 crores an acre?
No, this is Pocharam, which is eastern Hyderabad, on the other end of Hyderabad. If you study that micro market, you will probably have a different view on valuations completely from what you're envisaging for Madhapur, etc. We have 4 lakh square feet lying vacant there, and we find it extremely difficult to lease. And the rents are in the range of 20 and 25 rupees per square foot. Sorry?
Yeah, and the price at which the transaction has happened, if you could clarify that?
Yeah, so the transaction is at 80 crore for 40 acres, which is about 2 crore per acre. This is what was disclosed in the offer document as well.
Thank you. And the first question,
please. Coming back.
Longer term view on this.
Yeah, so coming back to your first question, some of the things which I had mentioned earlier as well. So part of this was any which ways envisaged even at the time, of our projected numbers during the IPO. And the balance is because of certain cash flow phasing. Like, for example, we are getting some of the tax refunds which are coming in earlier as compared to the quarters that we had envisaged. Some bit of, working capital which is coming up in advance. So some gap is bound to continue to remain, while some of the gaps, by the time we end our financial year, some of them should normalize.
Understood. But the fact that about 20 plus % of your distributions are being funded by debt, is that the correct assessment?
No, actually that's not the way you should be looking at. And, since you mentioned 5 quarters, the first 2 quarters, if you looked at, we had almost received close to about 100 crore of tax refunds last year in H1, which was actually contemplated in H2. So now those were our cash flows planned for H2, which we received well in advance, and we had paid down the debt. So obviously, we had to draw that debt back when we were doing distributions for H2. So a large amount of that number actually happened in H1, which we took by way of debt in H2. So similarly, again, when you are looking at this financial year, we have almost, as I mentioned, 30-40 crore of tax refunds which came in advance. We have certain brokerage payouts which have happened because of huge leasing that we've done in these quarters, which we've paid this time. We've had certain power costs which I was mentioning, which will be trued up only in the next financial year. So that gap may, remain for a little longer. So it's a combination. So it wouldn't be right to say that 25% is funded out of debt. It's more of managing the cash flows as and when they come. When we get the cash flows in advance as a prudent practice, we take that money and pay down the debt and draw that back when we need it.
Oh, this is good. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Rajan from Elite Holder. Please go ahead.
Actually, I wanted to understand that the ROFO asset that we are getting, okay, is there any possibility of we are funding it totally through debt?
Hi, Rajan. As I mentioned that we're just going to start the evaluation now that we've got the board approval. Having said that, one of the options which we have is also swap of units of the REIT with the SPV shares. It is unlikely that this will be fully funded out of debt. But as I said, we've just started the evaluation, and we'll take the next few months to evaluate what is the most appropriate capital structure and the method of acquisition.
Yeah, sure, because recent days we have got higher prices, so we can be diluting less. So that's first thing. And second is about the lease agreements. Okay, like say what type of escalation clauses are there? 3-year, 5-year. I mean, in general, I want to understand.
They are standard escalation clauses as they used to be. In most cases, between 13 and 15% every 3 years. And it's moving towards a trend where some leases we are able to even get annual escalation.
Okay. And it will be better, okay, next time, you more priority in call to unit holders rather than direct some security firm which have no relation, no direct relation, okay? So that will be great.
Sure. Thank you so much.
Thank you. We have, before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Shashank Savla from Somerset Capital Management. Please go ahead.
Hi, thanks again. I wanted to understand the committed occupancy and the occupancy. If I look at the last 4 quarters, the committed occupancy has been between like 84 and 85%, but the actual occupancy hasn't improved. And this was coming back to your previous statement that it takes like 4 to 6 months for that committed occupancy to flow into the occupancy. So why haven't we seen that actual committed occupancy flowing into the occupancy numbers?
So there are 2 parts to this. One part obviously is whatever is, take for example, when you're leasing out something, at the same time you have a customer who's exited and terminated their lease. Till they are physically occupying, it doesn't factor into your vacancy. While we may have announced their exit, because when we receive the notice is generally between 4 and 6 months, after which the tenant walks away. So the impact starts to show in your occupancy vacancy numbers only after that 4 or 6 month or tenure gets over. And that's when it may drop or go up. At the same time, every quarter you're leasing fresh, new space as well as release of vacant space. And that vacant space factors for committed occupancy at the same store. And if there's new or under construction, that gets added at a later date. So it's a constant sequence of leasing that takes place. There are separate operations that are taking place parallelly. The effect is shown to you on the presentations every quarter. And sometimes where the LOI is signed, which is binding, till the time it doesn't move to a binding agreement that is registered, it stays as occupancy, committed occupancy versus confirmed only when we do a registered document. So that's where the gaps are.
Right. So, and just trying to understand, given the current sort of environment and given that you still sort of give a few months of free rent, would we see any meaningful improvement in the actual occupancy numbers in the next couple of quarters?
We should see definitely. So if when we discussed about the September quarter, we were at 7% at the end of that September quarter, while we discussed with you towards in November, December, we had already reached 14% occupancy physically. After the Omicron wave hit us, the occupancies dropped down. We will see them catch up, I think, in my view, from March going up to May, you will see the occupancies climb back up really quickly.
Right. And any change in the base rent or incentives which you give given the improving environment?
For us, it's about the selection criteria about the tenant, what is the quality of tenant and what is his stickiness on the portfolio. And we will do the best rate that we want to get and for the tenant where he's satisfied with the rent number. For us, it's a win-win. We want to take volumes, take the right tenant, and move forward. It's business as usual.
Right.
And the numbers are firming up. For grade A assets, the numbers will firm up because grade A assets are going to thin out in terms of supply over the next few quarters.
And one final question. I just wanted to understand on the taxes. So what exactly are they for? Like, because for a REIT, given that they have some tax advantages, I just wanted to clarify what the taxes paid for are actually for, and what sort of rate should we assume going forward?
So you mean taxes at the company SPV levels or taxes in the hands of the unit holders?
So taxes which you show at the consolidated level, at the corporate level.
Right. So essentially these are the taxes which the asset SPVs land up paying. So these taxes depend on each of the SPV, because some of the SPVs still enjoy tax benefits because they are SEZs or they were IG parks, in which case MAT is something which is applicable. And in all the other cases, which is again around 29%, so that's what is applicable.
Right. Okay. Okay. Thank you.
Thank you. We have the next question from the line of Manish Agarwal from JM Financial. Please go ahead.
Yeah, hi. Thank you. My first question would be pertaining to the liability side. So we have considerable interest cost benefit over the past 1.5 years. So how do you see the trend going forward? Because it will have a direct implication on the NDCF. So what are the broad conversations you're having with the lender side, if you could indicate that?
Manish, we couldn't get your question.
Yeah,
Can
could
you
you
please
please repeat?
Yeah. So my question is pertaining to the liability side. So we have had the interest cost benefit flowing to us, which provides a buffer to the NDCF in a way. So going forward, how do you see this trend playing out, the interest cost? What are the broad conversations you are having with the lenders right now?
So Manish, in terms of the debt conversations, so of course we've seen a good 250 bps reduction in our interest cost, and that's one reason why we have been converting some of our fixed variable cost into fixed cost, and now as we talk, we're almost 50% on fixed cost. So some of our debt is already locked in at these rates for the next 2 to 3 years, depending on when we had raised the NCDs. So that's one thing, and we're already working on converting a little more of our variable cost into fixed cost, and of course we'll take a call. Some of that can continue to remain at the SPV as variable cost because these are long-term debts. So that's one thing, and of course this year, as you're also aware, we received a huge benefit vis-a-vis our projections in terms of our interest cost. Versus our projected numbers in the FOD, we will continue to receive that benefit next year because that was the cost which was assumed even for the next year. So that should continue. But overall, in terms of the NDCF, as we said, because now in terms of the leasing, also the rentals which are going to come from the leasing that we've seen now, we should definitely see an improvement in our NOI also as compared to FY22, which should also add to our NDCF.
Sure, understood. And secondly, on Commerce Zone Porur, we have seen traction. Occupancy has moved up, committed occupancy. What sort of levels can we head towards? What is the leasing pipeline over there looking like?
We are constantly looking at picking up on leasing that building out, and we are seeing the traction begin slowly, albeit for Chennai. We're quite confident we'll be able to lease this asset out soon.
Sure. Thank you. That's all from my side. All the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. As there are no further questions, on behalf of Mindspace Business Parks REIT, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.